Alright, so in this video, I'm going to talk about my confirmed profits for the month of May. So these are trades that might have been opened in April or May, but were closed in May. And as you know, the bulk of my strategy in my margin account is selling SPY put spreads every Monday, Wednesday, Friday. I try to close it at 50% whenever possible. And if the put spread gets tested, I'll sell call spreads against it to reduce max loss, and hoping that the stock recovers back, goes above the put strike. And if it doesn't, I'll keep bringing the call side or the call spread closer to the put spread, creating an iron butterfly, but therefore reducing max loss by collecting a bunch of credits. So if we begin, I sorted this by symbol and then by expiry and then by date. So the first thing we'll see here is Alibaba earnings trade. So this one was open May 21st and I closed it May 29th. So usually earnings, I like to close it the next day, but I wasn't able to because Baba actually dropped. It dropped from 210 to 199 almost. So I wasn't able to close it. But on May 29th, I saw a small opportunity for profit. So I closed it for a $12 net profit. Now, I was expecting to make about maybe $40 net profit on this trade, but I didn't want any headaches or any stress because I saw Baba drop to the 190s and my short strike was 190, as you could see here. So I didn't want to take any chances. I'm like, $12 profit, just take it, move on. It's not the bulk of my strategy anyway, so why add stress to myself? So I closed it for $12 profit, but the next day I would have been able to collect much more profit if I had just held on to it an extra few days, because it was in fact trading at 210. But regardless, no loss, came out with $12 profit, but could have made more. The reason I'm saying why I could have made more is it's to show you that the strategy really works if you're just patient. I sold an out of the money put spread. I gave myself room for error. The stock dropped a lot, but because I gave myself room and time, the stock eventually moved up and I would have been able to make my expected profit. So the capital required for this trade initially was $412. So the return on capital is 3% in about 8 days. And then I've got another earnings trade on Nvidia. I think this one went well. So this one I opened May 21st, but I closed it May 26th. So I wasn't able to close it the next day. It was the 310 strike. So as you can see, it's pretty far from Nvidia. I think Nvidia was trading at 360 at that point. Closed it for a net profit of $40. So this is after commissions. Return on capital was $403. So, or capital required was $403. So return on capital was 10%. Not bad in 5 days. And this one here is my regular SPY put spread. So the May 27th expiration was opened April 27th, closed May 8th. So it took longer than usual, but closed it for a $29 net profit. Return on capital was 7%. Now this one here, if you watched my April video, this was the last trade on my April video. It was the May 29th expiration. It was a SPY put spread that started off with a 275 put. The short strike was 275. So I opened it April 29th and expiration is May 29th. Now what happened is on May 13 or May 14, SPY dropped to 272. So it dropped below my short strike, and my management style when the put strike gets tested is I'm going to start selling call spread against it. So on that day, so it was May 14, there you go. So on May 14, the SPY was trading at around 272, or it hit a low of 272, but then came back up really quickly. But I had already sold my call spread at 295-300, so on the other side. So I'm creating two restrictions or two borders right now. Now I need the SPY by May 29th to stay above 275 and 295 for me to win. But the reason I sold this call spread is to collect a credit of $45 over here. It's just to add more credit to the trade in case the SPY continues to drop below 275. So instead of losing max loss of $420, let's say, collecting free credits from the other side, from the call side, therefore reducing max loss on this trade. But at the same time, I'm still selling new SPY put spreads the following days. So what happened is, if we look at the chart, you can see that the SPY just flew right after that. After it dropped to 272, it just flew every single day all the way up to 313 almost on June 3rd. So I had no chance. My SPY put spread, so my SPY call spread here at 295 300, which was used to mitigate this initial put spread that was tested very briefly, ended up costing me a lot of money. I ended up losing $335 with commissions at the end. But as you can see, there's a lot of trades here for the May 29 expiration, because these were just call spreads and put spreads that I was trying to bring closer to the market price just to collect extra premium from this trade. Now, did I do something wrong with this? Could I have done anything better? So first, I think I could have waited a little bit. I think I should not have sold the 295 call spread right away, because on May 14, when the SPY dropped to 272, it came back up right away at 276. And I guess I should have waited before selling that call spread. That would be one thing I could have done better. The other thing is, maybe once the put strike gets tested, maybe it's just best to reduce max loss completely, and maybe it's just best to close the put spread. But the reason I don't do that is because I feel like I might be eliminating potential winners. I might be getting rid of potential winners, because as you can see, this one was a winner if I had just held onto it and did nothing. So very often, even if your short strike gets tested, it eventually comes back up if you have enough time in the trade. So that's why I don't like closing the trade for a loss if it gets tested, because I feel like there's a chance for the trade to become a winner. But what I could have done to reduce max loss is maybe brought the call spread to the closest possible. So I could have brought the call spread to 275, 280, creating an iron butterfly. I would have collected about, in total credits, probably would have collected about $350. Therefore, my max loss would have been $150. So instead of losing $335, I could have just lost $150 if, when the SPY traded below 275 on May 14, if I sold a call spread right away at 275, 280, turning the trade into an iron butterfly. What's the advantage of that? I'm giving myself a chance for the trade to become a winner. If the SPY closes around 275 come May 29th, then it becomes a winner. But I also reduce max loss by a lot. So I do two things at once. So maybe that could have been a better management or better risk management of this trade, because instead I lost $235. Kind of annoying, because all my gains are small amounts here, right? So if I lose 300 in one shot, it erases a lot of my gains. So therefore, this means that there must be a better way to control the losers. Either cut them out quickly before they become too big, either by closing the put spread right away, maybe at 2 times the credit received. So if my initial put spread, I collected, let's say 80 cents, then as soon as the put spread is worth maybe $2.40, maybe just close the trade right away. I would lose $1.60 in that case. But in this case, it would have been better losing $160 than $335, and move on and trust that I'm going to have way more winning trades that will compensate for that losing trade. Now, I don't think doing nothing would have been better. In this case, doing nothing, I would have won. But in March, doing nothing would not have been good. I think you have to take action when your put spread or your short strike gets tested, because sometimes the market will just free fall and you're giving away free credits by not selling call spreads against your put spreads. So I think I'm leaning more towards waiting a bit before managing. So waiting until maybe the 270 is completely breached, and then selling a call spread at the 275, 280 strike. So selling a call spread as close as possible to the put spread, turning the trade into an iron butterfly. So I do two things. By waiting a little bit gives me a chance to see if the SPY is going to come back up. And if it doesn't, well, then I'll try to collect the most credit possible to reduce max loss. So now the trade, I have to let the trade go. I can't expect it to be a winner anymore. I'm just trying to reduce max loss as much as possible and just move on, knowing that I'll have other trades that will be winners. I think that would be a better management style of the tested trades. All right, so June 1st expiration was open May 1st, closed May 8th, so 7 days. And this one was a $25 net profit, a return on capital of 6%. This one here, June 3rd expiration, was open May 4th, closed May 7th, so 3 days. Able to make 50% profit, so $26 net profit with a 6% return on capital. This one here was the June 5th expiration, opened June 5th, closed June 11th, so 5 days, $22 net profit, 5% return on capital. This one here was the June 8th expiration, May 8th, opened May 8th, closed May 20th, so this one took 12 days, so this is quite long actually. It normally takes a week, but this one had a 7% return on capital. This one here is still open. It'll be closed in June. It has a June 8 expiration, but this here is a put spread or a call spread that I used once again to mitigate the first put spread that got tested, which was a 274 strike, but I closed the put spread when the market went higher, so I closed it for a profit, but I still have the call spread. And then I decided to sell a put spread again, so I reopened the put spread to collect more credit because the call spread got tested. So on May 26th, the call spread was tested, the 300 strike, so I sold a put spread lower just to collect more credit. So this one looks like it's gonna be another loser, similar to the other one, similar to the May 29th. So basically these were the two strikes that got tested on May 14. So this one should be about maybe, I think, another $300 loss, but it'll show in the June report. All right, moving on. So June 10th expiration. So open May 11th, close May 20th, $22 net profit, 5% return on capital. And this one here, same net profit, so that's crazy. So June 12th expiration, it was open May 13, closed May 19, so 6 days, $22 net profit, 5% return on cap. This one here was the June 15 expiration, open May 15, closed May 18, so 3 days. So I really love when it closes really fast like that. 6% return on capital, $24 net profit. This one here, $26 net profit. It was the June 17 expiration, open May 18, closed May 26th, so pretty fast as well, 6 days with a 6% return on capital. This one here was the June 19 expiration, $27 net profit, open May 20th, closed May 28th, so 8 days in the trade only out of 30 days, 6% return on capital. So you could see it's pretty similar. Obviously when the market keeps going up like that, it's easy for these put spreads to become winners quickly. And finally, this one here, June 22nd, open May 22nd, closed May 28th. So 6 days, $25 profit, 6% return on capital. These ones here are still open. So I've got the June 24th expiration, or they were not closed in May, but I'm pretty sure they're closed in June. Yeah, I think I closed them in June. So this one here, $73 collected. This one here is the June 26th expiration, $74 collected, but it's not closed yet. Or in May it wasn't closed, so I can't really confirm it as profit. And Alta here was closed for a profit as well, but it was closed in June. This was an earnings trade, but I wasn't able to close the next day. So if I include these ones, it's about an extra $300, but it's not included, of course, because they were closed for 50% in June. So now if I look at the total closed profits or closed trades in May, I actually lost $5. So I've got a net loss of $5 for the month of May. So April was a positive 400 US, but May was a negative $5. Hopefully June will be better, but at least I can pinpoint the mistake, and I know that there's room to improve. And as long as I can find a way to mitigate the put spreads that get tested. But I also think that I was a bit unlucky because it's not normal that the market flies like that or rallies like that. It's not part of the regular market behavior. So that didn't help either, that the SPY drops to 272 and flies to 313 in less than 3 weeks. So that didn't help my management style, even though I think that the management style is correct. But I guess I have to deal with what's out there. And I think it's just best to bring that call spread exactly at the same strike as the put spread, collecting as much premium as possible, so reducing max loss as much as possible, but also giving the trade a small chance to become a winner as well. So I think I'd rather do that. The average return on capital this month was about 6%. All right, so if you have any questions, leave them in the comment section below. And like always, if you're going to open an account with Questrade to trade on the stock market, use one of my referral codes below. One of them gives you up to $250 back. The other one gives you $50 in free trades. So choose the one that suits you best. And if you enjoyed this video, please click the like button, share with a friend, and subscribe to the channel. Thanks for watching.